Hello, hello. Okay, we continue with Microsoft after Meta had fantastic earnings. Microsoft is actually down right now after hours, about 5%. But I guess this could change, if they have some news about guidance and stuff, we'll see. But probably, usually it stays about the same. We'll see though. Now, they beat consensus on the top and bottom lines as cloud growth moderated. The company had 37.5 billion in quarterly capital expenditures and finance leases, which is a little bit above the consensus of about 34, or actually maybe even significantly above. Now they will issue guidance, what I mentioned earlier. So guidance is always important because it tells you what the company is going to be doing in the next quarter. And so right now you may be seeing 5% on the minus. Later you could see plus 5% because of that, just if the guidance is better potentially. Now, yeah, as I said, 5% down for now. Now, earnings per share 4.14 adjusted versus 3.97, handily beating it. And revenue 81.27 versus 80.27, 80.27, so also beating it by a dollar is pretty significant. Now, the revenue grew 16.7 year over year, which is also nice, similarly to Meta, which had more than 20%, but still, for a company of Microsoft size, growing revenue 16.7% is kind of insane, frankly, and still going down, kind of insane. The expectations are amazing. Now, net income at 38.4 billion or 5.16 per share, up 24.11 billion or 3.23 per share, and adjusted earnings exclude impact from investments in OpenAI. The margins are narrow, coming in just over 68, if you could say that, for this kind of margin. And revenue from Azure and other cloud services grew 39%. Wow, that's impressive, compared with 40% in the fiscal first quarter, continuing tremendous growth here. An analyst had expected about 39 or 38 and 38 respectively. The company also reported about 10 billion in other income compared with the expense of 29 billion in the same quarter a year ago. And that's about the restructuring that involved, for OpenAI. And at year end, the company's commercial remaining performance obligation is stood at 625 billion, up some 110%. Okay. Now, the backlog is really good, but the disclosure that OpenAI is 45% of their backlog, it goes back to the situation where can OpenAI achieve these financial goals? Yeah, so OpenAI being a huge deal right now, as we're expecting them to be a public company pretty soon too. It's a bet, and people, and understandably so, are a little bit hectic about OpenAI. So maybe this is one of the core reasons why you see the stock going down right now, potentially, for now at least. Okay, and what we said about Azure doing really well here. What about the more personal computing segment that was down about 3% and below? Kind of understandable here, I suppose. This kind of segment of the market is not the highest growing these days. Gaming revenue also declined as Xbox is kind of a known thing being not doing really well right now, and there's a little bit of a strategy going on there. I don't even know how they're going to continue Xbox with all the competition they have from the PlayStation and even Valve lately. We'll see. And capital expenditures and leases came, what we said earlier, 37 billion. And all the rest are just some details here. But we'll see the guidance if it changes anything. This just came out. But if we take a look at Microsoft, you can kind of see in the past 3 years the growth has been tremendous as well, sitting at 100%. Nothing to sneeze at. It's doing really well. And the P ratio of the company is at 34. Now, if it goes a little bit lower today, maybe it's going to be near 31, 30, I don't think so 30, but maybe 31. And outstanding shares going about sideways for the most part. They haven't been buying so much. The price to free cash flow, again, kind of expected because they're spending a ton in capital expenditure. All these companies, the big tech, is actually spending a ton in capital expenditures, so it's kind of understandable. And the revenue, net income, equity, and free cash flow all up for Microsoft, with the margins slightly suppressed, but only slightly, As we said earlier, it was about 68% right now, right, for the latest quarter. So very close to what they're doing. And virtually no debt as expected. A company of this caliber, very unlikely to have any debt because they're making a ton of money, obviously. But what we kind of want to always be taking a look is what was happening in the previous quarter, which we have an overall score of about 70 here for 69 for Microsoft. And the strategic asset or an earnings landmine was the previous news pretty much on the previous quarter. That was Q1 2026. This one that came out is Q2. And they had the 4.1 net loss from OpenAI hit the bottom line the quarter. And AI is winning revenue for Azure but killing the margins because, running it is expensive, obviously. This is the stage where the companies actually grow, and it's kind of understandable. They grow their offerings with AI, and they're spending a ton. They not only have capital expenditures, they also have operating expenses for running the factories pretty much. So, or the warehouses, the data centers, everything. All these are operating expenses. And that's pretty much what has been going on here. The AI arms race, as the tool actually lets us know here. Okay, the other thing that we always want to be examining is the discounted cash flow model, just to see where we are at with the company's cash flows. Where is it heading? Is it actually making good money, giving potentially money back to shareholders as cash flow? But this is a high capital intensity company as well, which is the same thing that we saw with Meta, understandably so, because they're spending again a ton in capital expenditures. But we'll still run the model to see where we are at with the typical average sort of like assumptions here for our Lucky 13 model, which is near the revenue growth average, and the FCF margin average is near these values, like 30% here for the margins, and the revenue growth is about 15%. So we're playing at around these levels, as you see. And the intrinsic value calculated with this is going to be lower, of course, than you would expect, potentially because the company is spending a ton in capital expenditure, so lots of money going towards that part. But again, you kind of want to see where we are at and also account for that fact. So give it a little bit of a premium because that's what they are doing. It's a company that's actually spending a ton of money on investing for itself, I mean. So it's understandable. Even at this price here, I would potentially consider even like $100 premium here, even a little bit more potentially. So even buying at around 350, 370 or so, I would consider it a pretty nice price, frankly. Again, for a company of this caliber that is, making a ton of money and spending a ton, through the years, if you are holding, it makes sense. It makes sense because you have to account for the fact that they are actually sending their free cash flows out. It's not like they are keeping them, which would make these values significantly higher. This always matters. This is why the high capital intensity here tells you this, so that you can take it into account. It's very good information. But yeah, that's what's going on with Microsoft right now. Tell me, guys, if you own the company, if you are thinking of buying it at this price. And this is the second one today. I made a video earlier about Meta, and Tesla is coming up next, I believe. Thank you for watching. If you want to visit the tool, stockaiinsights.com is where it's at, and there's a free account. So please check it out and let me know. I'd love your opinions. There's a ton of stuff going on here. So I think you will enjoy it. Thank you. See you soon. Bye.